You know, I was thinking, Kevin, with you, we came out of a period when, back in the 90s, when everybody was a day trader. You know, everybody knew how to pick a stock.
I remember,
whether you were someone who was a hairstylist and buying Microsoft and selling, you know, it was amazing. Everywhere you went, everybody was buying and selling stocks. You know, as far as your training goes, I'm assuming that today people are less inclined to do something like that. But how do you deal with the client that comes in and they want to pick the stocks or the funds? You know, what kind of advice do you give?
Well, usually if a client comes in and they have a fair amount of knowledge, we want to work with them. We want to educate them on the risks of individual securities. You may have the best company in the world, but if adverse news comes out and you have a major concentration of that one company in your overall assets, it can hurt you in a major way. So we preach diversification. We talk to them about asset allocation, how to allocate their assets the right way.
Right.
So even though you're taking some risk with individual stocks, you should also have some investments in long-term bonds that can produce a certain amount of income for you that can, again, offset any of the market volatilities that are out there. We also want to talk to them about limiting the amount that you put into each individual name. Efficient portfolio, you should at least have somewhere between 30 to 50 names in a stock portfolio to give more diversification. We want to educate them about getting involved with different industries.
Right.
Back in the 90s, a lot of folks, diversification meaning 2 or 3 tech stocks.
Right.
Oh, I'm diversified. I have Microsoft, Dell, AOL. Yeah. And they consider that as diversification when everything is one sector.
Right.
So we want to tell them that you need to be more diversified. You got to have various sector. Can't be all in technology. Can't be all in, let's say, healthcare, financial, industrial. You got to have investments in each area, because what might be hot this year may be cold the next.
So you probably have different clients. You probably have the clients that tell you, Kevin, you know, here's my portfolio, here's my trust. You do what you think is best. You know, stay in touch. Let's communicate. You probably have those clients, and then you probably have those clients that use you more as a vehicle and say, this is what I want to do, and this is what I want you to buy, and this is what I want you to sell. Which do you prefer?
Well, usually we like the
obviously
the first. The first.
But can you accommodate the second?
Absolutely, absolutely. And even the ones that like to self-direct most of the investments, we can work along with them. We can advise them what our view on that particular investment, and then we'll leave it up to them to make that final decision. But we also want to keep in mind that they shouldn't take too much risk. No matter how much you love a certain company, we've seen it time and time again where people get overweighted and they put the bulk of their money into one particular company, goes south, and now their whole retirement plan or their estate plan.
Yeah. Do you ever feel the need to protect yourself against a client who's is making a very risky, incorrect move?
Well, we take meticulous notes, especially when they're dealing with accounts such as a trust account. A lot of our trust accounts, we put down investment policies, what our suggestion for them to do, what they should do, they shouldn't do. And it helps. It gives them a guideline. Right. So if they really want to do something out of the norm, let's say, and we think that they're taking extensive risks, at that point we might even ask a client to maybe go to another institution, worst case, because if they're with us, we want to make sure that they're doing the best thing for the long-term growth of their assets and make sure that we can preserve those assets for their loved ones.